markets, but the big headline this morning is Accenture going and cutting their guidance for the full year, talking about outsourcing that could see a mid-single-digit growth. So there's quite amount of caution in their voice. Let's find out what is the read-through for other IT companies. Happiest Minds Technologies is the first management joining us on the show. The company also recently revamped its organization structure. There's a new vertical organization structure comprising 6 new industry groups. So we have Venkatraman Narayanan, the managing director and CFO of Happiest Minds Technologies, joining us now. Venkatraman, thanks a lot for joining in. Before I ask you about your own, business, I wanted your thoughts on the commentary that came in from Accenture, not just about them cutting their guidance, but also talking about how outsourcing will see a mid-single-digit growth going forward. Is that your assessment as well about a reduction in client spends, about weakness in terms of outsourcing? What is your own expectation as we move along?
My personal view on this is, process to process. So it's as each company views it based on their customer and the prospect base that they are chasing right now. Accenture at such a big size, they are doing 16 billion a quarter. For them, a difference of a percentage is as much as many happiest minds, to just give you a case. So what I'm trying to say is there is something which is environment related, something which can be company specific, and something which is basis their current customers and the prospects that they have, or the channels that they are pursuing for business today. So which is what could explain maybe the 1 or 2 percentage differences that they are talking about. As far as Happiest Minds is concerned, we've been talking about holding on to our guidance. We said 12 to 13%. We did adjust that in the early part of the year, and we are holding on to that. The last 3 quarters, we have met the guidance numbers on our growth and also on our EBITDA.
Okay, so you will hold on to your guidance for the full year for FY24. Do you think for FY25, will it be similar to the organic guidance that you've seen in FY24 of around 10 to 12%?
That's what we are expecting, but I don't want to say anything on that front unless we get the numbers put together. Right now, we are going through our annual plan session. So we are putting all of the numbers together. We are seeing decent sign-ups happening. And as you know, we have signed up about 40 new clients last year. There are existing projects which are also ramping up, despite the prioritization that's happened over the year. So we're putting all of this together, and we'll be back to you once we look at the numbers and we run it past our board, and we have those numbers which can be shared with the external world.
All right. Hi, good morning, Mr. Narayan, and good to see you in. Nigel on this side. Well, tell us more about this organizational changes that you've made, moving to a vertical structure. How does it help you all in terms of growth? And also, I think you'll be focusing on the revenue per customer scaling up. If I look at the trend, a couple of years or so ago, it was 600,000, which moved to around 800,000 odd. And you all had guided that it moves to around 1 million USD per customer. Does it help that?
Absolutely. The idea is to, our goal is to reach $1 billion by 2031, which if you do a back of the envelope calculation, but we have done, so some amount of simulation, it says that you will have to have about 600 customers with about $1.5 million of revenue per customer, which would mean that we touch that goal of $1 billion plus. So we have to work towards that goal. You need to make sure that you go deeper into your existing set from 808,000 of an average revenue. We have to touch those million and then slowly ramp it up to $1.5 million. We're talking about averages here. So you have some certain large customers, certain mid-sized customers, and it's all a mix which leads to this number of 1.5 million. So having just a salesperson and maybe the vertical people until now who acted more as pre-sales support, you today have something like a two-in-a-box. So you have the sales structure and alongside the verticalized organization, both of them going into the customer with a lot more of domain pull, domain experience, and domain-led consulting. Which only lets you go deeper into the customer. And all of that means you're targeting and you're trying to make the job of touching the $1.5 million or whatever that number that we are targeting for, that much easier and achievable. Earlier, the sales, which was led a lot by technology, and then you had the verticals and the domain following through. Today, you have both of them in the front end, and both of them are talking technology. Both of them are talking possibilities that we Happiest Minds have to offer them around the business that they are.
All right, so I just wondered that timeline. By when do you hit this $1 million per client mark? The timeline?
No, I said 1.5 million is the number that we should be targeting. That is by 2031. So
correct.
808 today,
yes.
And slowly we are taking baby steps. And it all dovetails to the growth of the company. We grow at about 20% CAGR. You bring in that through acquisitions, you bring in that through organic growth, and all of this lead to that averages that we're talking about.
Okay.
It's a course that we have set for ourselves.
So 1.5 million per client by 2031. So that's a long-term roadmap that you've set out for yourself. Got that, Venkat? You know, just to go back to this issue about the immediate environment and what clients are saying. Now, Accenture, basically said that the delays are being seen in, more in short-term deals. Now, you're a company that's been born digital, and also you're taking this whole sort of strategic, change in terms of going vertically down in terms of sectors now. At the same time, there's so much happening on Gen AI, so there's so much going on. Can you elaborate a bit more? You're saying top-line growth will still perhaps be 10 to 12%. But really, what do all these changes mean in the near term? In the next couple of quarters? Will we see sort of straight line growth, or can it get extremely choppy?
I again say this is all customer specific and company specific. So as I speak, each company has its own set of customers, and which is why you see divergence in these numbers versus Accenture versus Wipro and Infosys and the many mid-sized, small-sized companies around here. So you have to. There is an industry trend, there is a macro environment issue, because if you look at the commentary on Accenture, they're talking about, interest rates and how that's hitting the economy, and which in turn is talking, flowing into capital formation and the way spends are happening. Asks of ROC, which are coming from the finance teams on new spends. Return on investment is being asked for nowadays. So these are all things which happen when there are tight economic and monetary situations. But also one has to weigh this in comparison to the programs or the project size that we are talking about. A multi-billion, multi-year program obviously gets challenged on these fronts or questioned on these fronts. But we are talking about continuing to build what you have in place. If you slip on your technology spend, you get set back by a couple of years. So when these questions come up, which is on your existing platforms, existing technology, people immediately continue to spend rather than wait for the things on the interest rates to change and those kind of things. So you've got a macro environment issue and you've got a company specific issue. So you have to balance both of them. Accenture commentary I see as a industry and environment related point that they have made. Very valid point. We are also seeing that, which is why we recast our guidance, which was 25%, including inorganic growth, to where we are today of 12 to 13%, because there was inorganic did not happen, and there was a little bit of an adjustment in the organic part, given the way the business has built out over the last year.
Yeah, I just wanted to actually clarify that point. The 10 to 12% you're saying is organic. Is inorganic, is inorganic still on the table? Just throw some light also, in terms of if you look at inorganic, what sectors will you target? What kind of companies? EdTech was a bit of a weak spot in the previous quarter for you as well. So just maybe some more color on sectors and the M&A opportunities that you will consider.
So the M&A opportunities are 100% digital, profitable companies. We are not in the business of turning around companies. All of that has been made public. Now with this verticalization, it just sets the ground that much better for integration. When we acquire a company, most companies which are of a certain size have certain capabilities which are around verticals. So you're able to plug that nicely into our organization, which is more verticalized right now. We are also making investments in generative AI inside our own company. We have started a new business unit on generative AI. So these acquired companies will bring us customers. They bring in capabilities. We are then able to cross-sell upsell quite a few of our capabilities like security, analytics, AI, and generative AI into those companies. So these are all the aspects that we look at when we are looking at M&A. Talking about M&A for the current year, we've got only a few days left, and I'm not sure if we are going to be able to. I don't think we have anything which will change things for the current year, but for the next year, obviously, the pipeline is good, and we are continuously in dialogue with prospects and possible candidates.
Sure. Anything in this calendar year? Anything in this calendar year that we can expect on the M&A front?
Yeah, absolutely. That's the idea, because we've been talking about this. We've raised capital, and we are working very hard on that.
Got it. We'll wait by for more details on that. Just one final question on EdTech, because, a lot of companies have been speaking about how EdTech growth has been under pressure. In fact, HDFC put out a note where they said that EdTech will decelerate in FY25. What is the kind of pressure that you are witnessing in this segment?
Just a clarification on our EdTech business. Our EdTech business is almost 100% US, UK, and focused outside India. So we don't have anything within India. So to that extent, the HDFC comment, I'm not able to correlate completely with our performance. In absolute number terms, EdTech has grown year over year for us as well. It's only in percentages that you will see those differences, because there are the manufacturing, and manufacturing has done very well. So has healthcare. Healthcare came up from nowhere. We were at about 7%, and today it is at 14% and growing. So it's on a comparative basis. EdTech shows a shrink, but not in absolute terms. Our EdTech is focused on the US. So there are three segments. One is school education up to K-12. Then you've got college education, and then you've got continuing professional education. These are all areas where we are seeing quite a bit of investment happening. A lot of new technologies being brought to the fore, including generative AI, and we are plugged into that well. And finally, at 24% of our business from EdTech, we are today positioned very well amongst prospects and customers. Whenever there is a talk of technology that's required for an EdTech customer, they do. Most probably, we'll get a call to present our capabilities.
All right, we'll let you go on that note. Thank you for answering all our questions with so much patience and giving us a lot of information about the business as well. $1 billion of revenues by 2031. They continue to stick to that guidance, and they give us a lot more details on the business. Let's